There is an investor who got the market right. The fund they chose performed well for years, but the balance is smaller than expected. What went wrong? Not the market, not the fund, the placement. Every year, dividends and capital gains distributions arrive as taxable events. Even when nothing was sold, nothing was moved, no decision was made. The tax bill came anyway. Over time, that annual extraction does not just reduce the current balance, it compounds against the investor. A smaller balance earns smaller returns, which means the next year starts a step further back than it should. Most investors know which funds they own. Very few have walked through which account each fund lives in and whether that placement is working with the investment's tax profile or quietly against it. Most retirement investors work with three types of accounts: a taxable brokerage account, a traditional tax-deferred account like a 401k or traditional IRA, and a tax-free account like a Roth IRA or Roth 401k. Each of these handles growth and distributions differently. In a taxable account, dividends and capital gains are taxed every year. In a tax-deferred account, growth is protected until withdrawal, when it is taxed as ordinary income. In a tax-free account, qualified growth and withdrawals face no tax at all. Most people understand this in the abstract. What very few investors walk through is the specific question: which investments belong inside each container? Picking the wrong match between fund type and account type is not a catastrophic error in any single year. It is a slow leak that few balance sheet snapshots will ever reveal. The concept of matching investments to the right account type, what planners call asset location, has existed in financial planning literature for decades. The logic became more important as individual retirement accounts grew accessible to ordinary workers and as tax law created meaningful distinctions between account types. The early challenge was behavioral. For most households, the simplest approach was also the most intuitive: mirror the portfolio across all accounts. Own a balanced fund and hold it everywhere. That approach felt like discipline. The math eventually told a different story. When interest income and dividend distributions hit a taxable account every year, they create a compounding drag that mirrors how compounding growth works, except in reverse. The same mechanism that builds wealth in a sheltered account quietly erodes it in an exposed one. Here is how the drag works. Imagine a bond fund that pays interest income every month. If it sits inside a traditional retirement account, that income accumulates without any annual tax event. It compounds. Decades later, the entire balance is taxed once at withdrawal, but the growth in between was fully protected. Now place the same bond fund in a taxable brokerage account. Every month, the interest hits and creates a taxable event at ordinary income rates. The fund did not perform differently. The market did not change. But the portion that continues compounding after each distribution is smaller, because part of it was redirected to taxes each year. Multiply that over decades, and the difference in ending balances for the same fund in the same market becomes substantial, not because of a dramatic event, but because of where the fund sat. The principle becomes more complicated when different asset types enter the picture. Growth-oriented index funds held for years in a taxable account can be relatively tax-efficient, because long-term capital gains rates are generally lower than ordinary income rates, and unrealized gains do not create tax events until the investment is sold. A high-turnover, actively managed fund in the same taxable account generates frequent distributions, some of which arrive as short-term capital gains taxed at ordinary income rates. An investor who owns both a bond fund and a high-turnover stock fund may feel equally thoughtful across both positions. However, the account each one sits in creates dramatically different tax outcomes. The investor who placed the bond fund in the taxable account and the growth fund in the retirement account is paying more in taxes each year than the investor who made the opposite choice. The complication is that most investors do not have unlimited space in every account to perfectly sort every preference. Contribution limits, income-based eligibility restrictions, and the fact that taxable accounts often hold the most accessible savings mean the sorting rarely works out cleanly. An investor who wants to move bond exposure into tax-deferred space may not have enough room there for the full allocation. That is where the constraint lives. The goal is not a perfect distribution. The goal is prioritization, placing the least tax-efficient assets in the most protected accounts first and working outward from there. But that requires a working understanding of which assets are least efficient and which account type provides the highest protection. Without that framework, most investors default to intuition-based placement that quietly costs more than any individual fund selection would. Consider someone managing a retirement portfolio across 3 accounts: a 401k, a Roth IRA, and a taxable brokerage account. They hold bond funds, dividend-producing equity funds, and a broad market index fund. If the bonds and dividend funds both land in the taxable account while the index fund sits in the Roth, the interest and dividends from those holdings are taxed every year as ordinary income. The index fund in the Roth grows and will one day be withdrawn without any tax at all. The portfolio functions. The structure is backwards. The most tax-inefficient assets are in the most exposed account. The most tax-efficient asset, the low turnover index fund with minimal distributions, sits in the account with the highest protection. Reversing those placements where there is room would produce the same market returns with a meaningfully smaller annual tax cost. What makes this invisible for most investors is that brokerage statements do not show what was lost to structural misplacement. They show the current balance. They do not show what the balance would be if the same assets had been distributed differently across the same accounts. The comparison never appears because it requires running a parallel simulation with the same money in a different arrangement. That is not something portfolio interfaces surface. It is not something fund performance tables address. The performance shown in a fund's literature is identical regardless of which account holds it. The account structure is invisible to fund marketing. And so it tends to stay invisible to most investors until an advisor or a tax preparer finally runs the comparison, usually years after the original placement was made and well after the quiet drag has already been running. The right fund in the wrong account is still the right fund. The market will treat it identically. The tax code will not. Every distribution, every dividend, every interest payment that lands in the exposed account creates a taxable event whether the investor was paying attention or not. The question that runs beneath all of this is not which investment to add next. It is whether the accounts holding the current investments are structured in a sequence that works with the tax profile of each asset. The investors who get this right did not pick better markets or find better funds. They built the same portfolio in an order that lets more of the compounding stay intact. The adjustment worth making is not the next holding on the list. It is the arrangement the current holdings are already sitting inside.